So welcome everyone to sitting down with my good friend John Kurisko, a day trader who I love to talk to for his dynamic and kind of long-term experience in the market. So John, welcome to the podcast. Good to with you again. Good to talk to you again.
Oh, great, Etienne. It's great to be back here. I'll just, we just had a little chat before, and it's good to catch up after everything that's going on. I don't think we've talked for a year, maybe, but it's good to be here.
Yeah, it's been a little while. I'm not exactly sure how long, so I kind of want to catch up and see anything new on your side since we last spoke, a few months or years back, I guess.
Yeah. No, actually, yeah. I'm still very passionate about trading, and I'm still, doing my broadcast. And just to give you a little background on myself, I've been trading since '96, and then I started day trading radio in 2007 and started educating on trading and teaching my journey, my mistakes, and where I got to this point right now, which is, which I think everyone is driving for and striving for, is to be a trader, a day trader, a full-time trader. I mean, I love trading, so, I'm very passionate about it, and I love talking about it. So I do that every single day. And what I like to do is actually talk about the psychology of trading, because, I was going to tell you one story when I started trading before the tech bubble. So a lot of, it was very easy to trade back in the going 95, 96, things started picking up 97. You just had that money in the market. You would be making money. You'd wake up each day and your stocks would be up, depending on what you had in it. And it was just an amazing time. And I had a lot of people start trading back then, some of my friends and stuff, and I was doing well. So I actually opened up accounts for them. So I opened them up, four of my friends, 4 Schwab One accounts with $10,000 in it. And the stipulation was that I was going to teach them, they were going to come over and stuff, and I was going to teach them. And sure enough, that everything was going good for a couple of weeks. And then the next thing you know, they're coming into me and say, "No, John, I traded the stock. I lost, I lost half the money." And then everyone came back, and what they were doing is they were going on their own, and they had to figure it out themselves. And I realized that early, that we all want to trade. I mean, this is a passionate thing. If you're into trading, you're really into, sometimes you're really into trading. You're always trying to figure it out and trying to find the holy grail, which there isn't any. That's the spoiler alert. After you figure out everything that you do wrong, and you start to find things that you're doing right, and then you can capitalize on those, and you use discipline and patience to force yourself to do only the things that are correct in the market. And that is the key. And that's what I try to teach now, because I know how to make money. I know a certain setup. I build a business plan around that. And I think we might have talked about this the last time, is that, and you probably hear this from the hundreds of traders. I watched a lot of your videos, and I think the common denominator with a lot of professional traders or long-term traders doesn't come down to anything other than discipline and patience. Discipline and patience are the key, attributes to, being successful in the market. And, there's a lot of easy stuff you could do that's going to just prevent you from losing. And I, just the other day, someone in one of our rooms was taking a trade, and they were doing the valuation trades, the funded traders that they're really big now. He was trying to get his, qualify for his thing. And it was one of those days where the market went straight up, and it went straight up and straight up. And me with experience is saying, there's only one side of this trade, but there is so much kindling up there that everyone is shorting. It's just going to feed on itself. And I warned him about 30 points below where he finally blew up. But little things like that. I think you got to surround yourself with only trades that work. And I was just telling you, in my studies, I'm a stochastic trader. I studied George Lane's stochastics, and I've been studying those for 15 years now. And, I apply them, and I have a what I call a business plan that's around my technique. So that way, if you have a successful business, if you borrow a franchise, a Dunkin' Donut franchise, a McDonald's franchise, whatever, they would give you a manual on how to run the business, because they know how to run the business. Now, I made my own business, business plan and run this as a business, because if you don't, you're going to just be all over there. And if you have a product to sell, and a product for me is just 3 trades that I'm looking for in the market, that's it. So it keeps me out of the junk. It's very easy to identify the trades that I'm getting into, and everything's defined around that. And that's my business plan. So I was going to share that with you today, the business plan.
It's pretty cool. And you mentioned something nice, which is the power of like learning and focusing on like one thing, like one tool that you're using now, using Stochastic from different people, of course. But I wonder what results people will get if they just like focus and learn like 10 years and like to one indicator, like one tool, how to use it, how to get better results. I think people will get much better results than they do now, than trying all these different things and all these different tools at the same time.
Yes, Bruce Lee said it great. He goes, I don't fear a person that can throw 1,000 kicks, but I fear a person that could throw one kick 1,000 times, like become an expert at something.
It's just so good. Yeah, definitely good. That's the trading also in your case.
So I'll show you my, because I want to get to the point where I'm trading these stochastics now. And I think this, and it probably applies to everything. I know you have, you trade Forex a lot, right?
Exactly. Yeah. Forex.
Yeah. So I don't trade Forex that much. I trade futures and stocks, and this applies good. And this even applies to Bitcoin, believe it or not. So I'm sure it applies to Forex just as much. But like you said before, there's so many indicators out there, and people could get confused now. If you have any charting service, you pull up your indicators, it's a list of 100. How do you make anything out of that? Well, the stochastics are great because of, and I'll give you a fast little, like a little crash course on that.
Yeah, that'll be cool. That'll be awesome. I think people will like it.
All right. So this is, I write it down for myself. I also give it out to whoever wants it. So if someone's interested in getting the business plan, just let me know. And again, I think a business plan is really for your benefit to lock you into a formula that's successful without straying too much. So you look at that business plan, it doesn't tell you to go off on a tangent and try to do something totally different. If something else works and you know your product, you go for your product. So every trade I have has to have an order entry, a criteria for an order, an entry, criteria for an exit, an automatic stop goes in. What's the risk management of the trade? I have a chart for that. How to increase your position size. And this is for longer term traders who are developing small accounts to larger accounts. I think I have a good, formula for that. How to set up your charts, tools for the trade. Don't miss it. And again, your balances and stuff like that. When we talk about how much money do you have to start with, as a trader, beginner trader, you should start with a minimum amount. And if you could do it with a minimum amount, whatever, $5,000, $2,000, I put it down, but you could just say that could be any amount whatsoever. But always remember that money is, could be lost. So it's all relative when it comes down to that. So with that said, and I trade stochastics, I have just a few setups that I look for. So I want to just show you what I look for. So I look for these are the 4 setups. I buy and sell divergences, the quad rotation, which I'm going to show you today. That's going to be something that you're going to really like. Channel breakout, stochastic rotation, oversold stochastic lower trend line bounce, and X marks the spot. So these are my little code names that I teach. I'll show you some examples of them, but the quad rotation is something I wanted to really touch on today because that's something I'm really focused on, and it's given me amazing results. And I think you'd apply this to all your trading. And again, locking yourself into a formula. And again, there's a lot of things that go into this, and I know we're limited on time, so it's very difficult to kind of go over everything. And again, you could probably, we could probably talk for hours about this. Stochastics are the basis of the methodology. And then these other indicators, I call them the 5 other indicators, things I look for stochastics to line up with. Is a stochastic line up on a confirmed trend line? Is it on a moving average? Is there a recognizable pattern? Is there support and resistance? And is there a reversal candlestick? Because the stochastics here are broken down into 3 different types of stochastic setups. I like the divergences, Some of these names, these are just kind of names I given them. So Coil, Stochastic, triple threats, which is like a quad rotation, flag setups, which is a 2020 flag. And again, I look at stochastics like a doctor looking at or a cardiologist looking at an electrocardiogram. I look at stochastics like that. I break down every single, down here, you can see a stochastic oscillator going back and forth, and I'll measure that out against all my charts. And I know where the combinations, where they meet, the percentages go up in my favor of a trade. Just like if I go to a casino and I sit down at the blackjack table, and I've used this, as one of my gambling analogies, but if you're going to go into the casino, either to throw away your money or try to make money. If you're going to try to make money, you're going to pull out that little card and it's going to tell you, these are the best odds you could do. This is the best way of making money. You hit when this card is show, if the dealer has a 5 or a 6, it's a bust card, and you have a great card, you're supposed to split because that increases your odds. Well, it's the same thing with trading. Certain levels, especially stochastics here, and combination with other things, are important levels to trade. So for now, we've identified the only places we want to trade is when we have a stochastic setup plus another indicator lining up. And when that happens, you're staying out of all the other junk. You're only defining the levels you're getting into, and that's automatically keeping you away from over trading, which is, probably the number one killer for a trader is, just over trading. Personally, revenge trading. You have to stay out of the market more because the market's always out to get you, and it's going to get you. You give it enough time, you're going to get caught. So I go into some stuff here, identifying patterns and stuff like that. So I'll give you a couple examples of just things that I look for. What I call a 1, 2, 3 pattern is the most fundamental way of identifying a channel. A channel is basically 3 points. 1 point, and we could go, let's go back to this chart over here. You just need 3 points. And we call these pivot areas. And the pivot area is where a market moves from one direction to another direction, one direction to another. So every time you have a pivot, you have a potential for a line, line to be drawn, but you need another pivot because 2 points, you can make a straight line out of 2 points. You can't make a straight line out of 1 point yet. But once you have your 2 pivots and then you have one pivot on the other side, you have a triangle and you can make a channel, a straight line, and then a parallel line. And all you do then is you trade the lines as they approach with the price. So that's one, technique right there. It's called the 1, 2, 3 pattern. You trade 4, 5, and 6. Now, when you have 4, 5, and 6, and they line up with an oversold or overbought stochastic, then you have what we call, a 2 or 3 star setup. It's much better than a 1 star setup, like saying, I have a trend line here. I'm going to get in on the trend line. And that's all you have. What if you have a trend line, an oversold stochastic, and a divergence? Those levels are the best levels. And I rank those trades higher, either a 2 star or a 3 star divergence or a setup. And depending on how many stars I am trading, depends on how big of a position I want to take into that trade. So everything is defined for me. Everything is defined. I don't have to make a choice, because if I made a choice and a split second in this market is, you're too late and then you're chasing, and the market's so good to come back and kind of put a little fear in you where you get shaken out of the trade because it's volatile. And the markets are full of algorithms and black boxes and everything else that's kind of going on here. So again, that's what I'm always looking at. I'm looking at these channels. There's a couple setups that we liked, what we call a channel breakout in the first pullback. Because whenever we have it, again, standard, you might say, oh yeah, I know what this is, but you really know what it is. I mean, the channel line is basically a change of trend. And now you have a new trend, but this pullback represents the first higher low in the new trend. So this is a downward trend. Now we have an upward trend, but we have to have a pullback to confirm the upward trend. So we always buy the first pullback out of a trend line breakout. And especially if that pullback comes into the trend line and it's oversold. that becomes, and and you see that box right there. For me, and again, a shameless plug, that's what I do. I send these alerts out to people who want them. If you're like, all right, I want an alert on Visa when it hits its high probability zone. So I'll set it up. This gets attached to anybody's account. And then when these levels get hit, you get an email or whatever, and it alerts you to these levels. And the same thing on the profit zone and same thing on the stop. These are all defined. That's why I have these charts here, because these are past charts of the HPS setups. So recently, now I have all my combinations. Here's a coil stochastic. This is a great technique if you have a stochastic with a series of lower highs. The timing on this is great. It's one of the best timing trades ever. So you have a downward channel. The channel has to be underneath the coil. And when you get down to the coil, at least 4 lower lows, lower highs on this. And then on the 5th or 6th, you're going to get a breakout of the coil. And the break of the coil, and this is the coil, this tightening of the stochastic band down here. And that corresponds with the same channel here. But right when you're down here is where your entry goes in. And your entry always goes in here when the stochastics are oversold, about the 5th curl down, and you're inside of a channel right here. And that's your first trade. And that's a real great high probability trade. So we put that on our business plan and say, all right, that's the only trade I want to take. That trade. I want to take a rising trend line and a recognizable pattern with an oversold stochastic. So I have about 4 trades I'm looking for, and that's all I'm doing. So I'll take a break here, and I'm going to just take I want to show you one thing, and then I guess we could talk about this. But recently I've been applying I'll show you my stochastics here. This is just a typical chart of the futures, and there's 4 bands here. And this, like I said, you might not see this as a typical stochastic oscillator, because typically you have 2 lines. You have a percentage K line and you have a percentage D line. Well, the D line, George Lane developed the D line as the signal line. So we have the 4 bands of the stochastics, and typically we have a 9-3, 14-3, 44, and a 60-10. And like I said, typically you have 2 lines. George Lane developed the D line as the signal line. The K line is and again, you have to have a little knowledge of stochastics and what they represent and why they represent what they do. George Lane came up with the stochastics, kind of there's a couple old stories on the internet. You could dig it out. It's kind of interesting. I think it was a bunch of Polish concrete workers that developed the stochastic oscillator. And it was never meant to be used as a overbought and oversold indicator. It was meant to be used as a divergence. And what stochastics measure is momentum. And you're looking back, the percentage K line is how many candles, how many periods you're looking back. And the D is the moving average that you're applying to K to smooth it out. And that's the results that come out in your signal line is D. So as the market is going back and putting an average of how this candle is closing between, and again, with stochastics measures how the candles in the past period, the length of the candle, the bottom is called 0, the top is called 100%. So that's the range of the candle. And you're going to go back there and you're going to plot how these candles are closing on each candle, on each bar. And that's going to go into the formula. And it's going to start to plot. So all of a sudden you could see the price go up, but the stochastics start to come down because over time they're closing lower on the candle. So you're not really seeing that on the chart, but you're seeing it on this. So look at this one more time. See if I can show you this fast. All right, here, we'll take this one. So here's your price is coming down. It's coming down, but you made a low here. It started to turn over. And the price is kind of sinking down here. But what's happening is your stochastics are kind of going up as the price at this point is lower than the previous price. The stochastics here are higher than the previous stochastic. It's a very simple concept to grab. It's very simple, but so many people don't pay attention to it. When that happens, that means our candles over time are starting to close higher on average. So we're seeing that before the price moves. It's the only stock, only indicator that I like. I think that's I consider a proactive indicator and not a reactive indicator, where most of these things are reactive. So that being said, so these are the lines I have on the chart here: the 20, 50, 200, the stochastics 9, 3, 14, 3, 44, and 60, 10, and the candlestick counter, which I think is important. So that being said, it's measuring the momentum. So the momentum stalls out first in a move up or down. The momentum is shifting before the price moves, just like the power behind a rocket. A rocket will go. If you ever, deal with rockets or model rocketry or anything, you stick a rocket in there, it'll take off and push that rocket all the way up. And then the rocket fuel will die out. It will die out, but the rocket will continue to fly because it has a little momentum left before it starts to turn over and roll down. And that's exactly what stochastics are predicting. They're predicting the turnover. You see the momentum shift before the rocket shifts or the price shifts. And there's nothing better than that. There's nothing better than that at all. That little indicate, you hear this thing going off here. I want to bring it. I don't know if you can see this over here. This is what's going off. So I love stochastics so much that I programmed that into a bot, so it actually tells you when the stochastics are setting up here. I don't miss any of those. So that's over time, my business plan for myself was important that I didn't miss these trades. These trades are so great that I actually developed a little bot that kind of wakes me up in the middle of the night if I have my computer laptop next to my bed, and I'll let this thing, trade overnight. It'll say, stochastic divergence, or it'll take an entry, or it'll give me an alert. So I get up and I say, oh, all right, that looks pretty good. I think I'll take that. That's when I didn't have kids. Now it doesn't work that way anymore. The combination of using stochastics and other indicators. Now, this is what I would consider, and I want to go back here to the quad rotation rules. I'm just going to put it up there and you guys could pause it on the screen and read it instead of go through all this stuff. But this is kind of a couple of the rules I wrote down for myself that I pass on to you when I deal with quad rotations. And what I mean by a quad rotation is, remember, we're working with four stochastic oscillators here, 4 of these. And I'm looking for them all to come down together at the same time. Now, the 4 represent different time frames. Even though I'm tracking this on the 1 minute time frame, this is a 1 minute chart here. I have the 9-3, the 14-3, the 44, and 60-10. Now, the 60-10 is actually a 9-3 on the 5 minute. So I'm able to look on the 1 minute here and know where the 5 minute is at all time, because that's also very important for the people who are trading. You might want to have that bigger time frame in the direction of your trade. It's going to give you more confidence if you have a 5 minute turn back up on a chart versus in a 1 minute and a 5 minute and a 60 and even a daily. If all 4 of these were heading up, you would feel more comfortable holding the stock long term. Now, as a trader, I'm trading minute by minute using the 1 minute time frame, but I like to see that 5 minute time frame down here oversold too, because when I have the 1 minute and the 5 minute oversold, that's a dual time frame setup, and that gives us, again, the high probability zone that the market is going to pop. Now, and here there's an old trend line here that really just popped off of that, and that's things we go through. So that's the quad rotation trend line retracement, and then we have, I'll show you one more here. I have the quad rotation lower channel line bounce. Whenever there's a trend line or a channel line, remember 1, 2, 3 path. And I tell this to people all the time. I said, I could teach someone how to trade, but eventually they're going to try to figure it out themselves. And what happens with me all the time, or I find out with students and stuff, that they all come back, but for some reason, we all have to try to make, and that's not a bad thing. That's just, that's the school of hard knocks in trading. I always say everyone has to blow up their account at one point, just because if you didn't, you don't know how there's things like this that, traders will try to figure out their own way. I guarantee you're not going to find anything better than this right now.
Yeah, you definitely unpack a lot for us here. This is a ton of stuff. So, a couple of things I kind of wrote down and I took away from this. So, first of all, you talk about the zone, which is a big thing that people love to like look at one zone for the trade, and they think the one zone will work out. But combining more zones together kind of helps a lot. Have you seen any difference in like the win rate when you have like one zone versus like two or more zones at the same place on the chart?
Yeah. I break it down to, if there is, we'll call them zones. If we have more than, I don't take a trade unless I have 3 zones lining up. Three zones. I think I have a chart on which 3. Let me see if I find. I might not on this, but yeah, I need 3 things to line up. And first of all, the first thing I need is that again, I am trading for 25 years now, and I could tell you by no doubt that divergences are the best thing I've ever come across, and I've tweaked them. But the concept is there, the whole concept. And when you add divergences to other indicators or other zones, it only gets better. I mean, it only gets better. That's why this is considered my number one setup now: a divergence and a trend line, and a quad rotation, I should say. Actually, the quad rotation divergence. I mean, the trend line is just an added bonus. So when you have 3 like that, then my 6, it's unbelievable, the success rate. The only thing, our worst enemy is news, of course, the unknown, and understanding your trend. You might say, well, that sounds very easy. Well, it's not as easy as I make it to sound. It is easy because it's a defined criteria that you have to just look for. And once you find that, you have to push the button. That's the other part of it. You have to take the trade. You have to be there in front of it, because if you miss it, then you feel like you're chasing, and then you hesitate again, and then you are chasing. And that's the market psychology getting you. Unless these will give you great setups, but you have to almost see them as they're happening and say, wow, stochastics are rotating up. We have a reversal candle. Let me get in here. A lot of people say, oh, there was a divergence. Let me get in here. And then it starts pulling back. And they kind of get shaken out, not even take, because it is it's not everyone could take risks, well. But, having that success rate, you have to, I wrote a couple more notes here. I said, you got to trade your time frame too. If I get into a trade, I want to be able to take my profits real quickly. And that's hard for a lot of people to do. Because, when we get into a stochastic trade, and we know that how stochastics on the 1 minute time frame go from 9 to 3 to 14 to 3 to 9 to 3, we could typically follow stochastics on your chart, and that's momentum. That's the shifting of the charts and stuff. So a very choppy market's going to be very choppy, but it still gives you a reason to exit. I would say never take a trade on a stochastic on a 9-3 when it's up above 80, because the odds are, if we look back at each instance that we're above 80, we tend to pull back some. It would be silly to, even though the bigger trend might be up, it would still be silly to go against the overbought momentum. I always buy when the stochastics are turning back up. You're going to have momentum on your side. Always sell when the stochastics are getting overbought. So if you do get into a good entry, I always say, take your first profit off on your first move above the 80. That way you're not even dealing with this little thing. Then raise your stop to break even. So you have 2 things. First of all, you have to be traded with multiple contracts. And in this day and age, that's not hard to do, especially with the MES. I trade the futures. The MES are like very cheap. So you start off with 3 contracts, and just kind of on discount brokerage, you could put up $150. And that's a pretty good risk reward right there. And what we're looking for is typically 2 to 4 points. And I get, we have a stop, a trailing stop go in usually between 6 and 8 ticks, or 2.5, or 1.5 to 2 points. And then you just put a trailing stop in, a break even stop, but a trailing, and you just follow it up. And it's almost boring in a way that I've automated it so much with the stops, where the stops go in, what the entry has to look like. everything about it, where I have to take it off. It's almost, it's almost, I would automate it even more, but it just takes so much time.
I'm sure some people are going to say that they've tried this before and they fail at like trading divergences. What do you think is the difference between people who succeed at trading the stochastic and people who don't? Is it like how they understand it, or is it different?
Good question. Good question, because not all stochastics are equal. Not all divergences. If you're trading stochastics, you got to trade divergence. I don't know why you would trade, because there are too many instances where things get overbought and oversold. But there's a rare amount of instances when momentum shifts before the price shifts, and stochastics work so much better. I mean, take my 25 years of experience of telling you that. I wouldn't be passionate about it, and understanding how well it works. But the reason people are unsuccessful or fail at this is they're not taking in consideration the market that you're trading in. This is where you can't have things automated. I always say, let the bot, or if you have something automated, let it get you into the trade, but then take over manually, because you have to have a little understanding of market direction, desire to trade, the desire for the market to go up, is there a bullish trend? Is there a bearish trend? If there is a bearish trend and you're buying buy side divergences, you're going to go against the grain. It is so much easier to go with the grain. So a lot of people will take these trades and they'll have their parameters saying, "Oh, I need to get 2 points out of it." First of all, they don't have a perfect entry, so they're already say that the trade is going to give you, if you're trading real tight, small time frames, maybe you're getting, and again, this is hyper scalping almost. You're getting 2-3 points. And if you don't get a good entry, now you already gave up a point, and then you have to get out perfect. So all of a sudden that little profit area just kind of goes away because you're not perfect in everything. You're not going to be there's slippage. It's not going to be. So what you can say, "Oh, this trade could give me 4 points." You'll probably end up getting 1.5 points, a point at most. And if you don't take that point, you know how fast that comes right back at you. And just seeing the stochastic, so you can make money in this market if you took your trade off every time you were positive. I mean, every time the stochastics got overbought and you locked that in. I don't care if it was for $6 or $60, but that's how I approach things. I say these are $20 trades. For beginner traders, these are $20 trades. You have 3-4 contracts on, you get a point or two, and you take it off. Because if you're walking down the street and you see a $20 bill, will you pick it up? And sure enough, no one's going to walk past a $20 bill. This becomes a game to people. This becomes an arcade. But if you have $20 right there, you take that off. That's making money. We're gambling. Anytime we get overbought on the stochastics 9-3 rotation, and you're trading a 1 minute time frame, and you have a profit, and every time you get overbought and you keep your trade on, you're now a gambler. All right, you're smoking opium. And, why? Well, that's why people fail. That's why people fail because they're not being disciplined enough, and no one's disciplined enough. It's hard. This is a hard thing to do. I want to hit the home run too. I want to get in and say, this is going to be, I want to put my stop at the low of the day and walk away. And markets are crazy and they're going to come back. But the definites are there. But they're very small. And people are like, I think I get more out of that, and then they're down, and it just becomes a cycle. And who knows? This is one thing I want to ask you. I want to throw it back at you because you've talked to so many good traders, and I've been in the markets for 25 years, but I still don't know if I put my order on the board, is there a bot that's going to come down and grab it, and then it almost feels like that sometimes. So it's almost. I don't want to give them a shot. I don't want to give anybody a shot anymore. I do so much work getting into these positions, being here, and I see $20. I want to take the $20. The big trades will come. If you cut your losses, you're going to be successful. But it's hard because not everyone has that discipline. That's my personal opinion.
That's a very good point. There's a lot of common things in trading that don't work too well, that you see real traders don't use too much, like the thing you gotta look for 2-to-1 reward to risk, or or you gotta wait for this amount of of pips dollars to get a profit. And I find that people who get success usually don't tend to fall for that. They kind of stay away and have their own parameters. And if they win less than they lose on the average trade, it's fine. They just kind of have a different win rate, different kind of probabilities there, and they make money anyway. So having your own parameters based on what you know works, especially in these contexts where, like you've shown here on the chart, you couldn't like look for like a 3 or 4 to 1. That would be impossible in that case. So
I think this becomes much easier the further you go out in your time frame. Like I think it's very easy to make money in the markets, just waiting for an opportunity and buying quality names, on a divergence or an oversold stochastic on a daily or a weekly time frame when you have momentum shifting back up. I don't think it's going to be that hard. Gambling in the markets is tougher. The shorter the time frame, the more difficult it becomes. I say, for beginners, always trade the 5-minute time frame because it gives you that more of an extended trend, and you're not so like this is kind of, this is very intense when you're looking at a 1-minute time frame. You're trying to get $10-20 out of it without, that's a very active day. The 5-minute, I have about 2-3 setups a day, and you can let them run. And I'm just kind of managing the trade. But if I have a divergence on the 5-minute time frame, I would say 70% of the time that's probably the bottom of the day on a 5-minute time frame. And the 60-minute time frame, well, you get a nice 60-minute rotation on a good stock that has starting to get momentum back up. You could hold that a few days and feel a little bit more comfortable about it if you wanted to do that. I mean, not everyone's set up for scalping the market. I recommend, going out 60-minute or the daily time frame, find your divergences in a Boeing or an Apple and stuff. Wait for those things. Maybe they show up every 6 months, but those are the best opportunities to get into these markets. I show you every single trade. I could go through. You give me a chart, I'll tell you where the bottom. Where the bottom is will be a set of indicators that I follow, like oversold stochastics, divergence, and the trend line, and we're going to look back there and we're going to say, yep, that's where it would have been. But now, am I going to get in now? Am I going to get up at that all? Right up. We've gone up 300 points. It's hard to chase things up here. That's hard too. The bug. Trying to find a trade find an opportunity each day when not every day is going to give you that perfect opportunity, and you try to make something happen that you shouldn't. I think that's a major downfall too. It's just being in front of the markets and forced over trading.
There's a very big need for, especially new traders, but also at all levels, to place trades. Like they feel like if they're going to be traders, they have to place trades because they have to make money that day or they have to make money that week. And if there's nothing or like no quality setup, they want to find a new strategy that they can trade like more often. How do you handle, or how do you kind of get used to that need of wanting to place trades and not fall for it?
I do sometimes. I do fall for it. What I do is, I'll just say, all right, I want to take this trade, but I want to do one contract on the MES, which is like I'm playing the penny slots or something. I'm in the casino. I don't want to lose any money, but I'll go to this, I'll go over here to the slot machines and put it in to test and kind of practice a little. Or like you could maybe do sim. I think it just comes with discipline, and it comes with confidence. You know what it comes with? It comes with confidence that you have the best setups, and when the setups happen, they work. And that's exactly when I started becoming successful in trading. I remember, I started in 96, easy to make money in the tech bubble, lost my money after the tech bubble, got married, had a kid, had to not stop being a gambler, had to realize how to make money as this. If I wanted to live my passion, I had to really, figure out, well, now I need to make it a business. Before it was like, oh, live and die, but now another thing I wrote down here is very important to take your money out when you get money, wire it out each week, pay yourself, take it out of the account so you're not losing it, and then and repeat what you keep on doing when you're doing things right. You're going to tend to repeat those. And when things are wrong, for me, I don't do them again. And I realize what was the right thing and what was the wrong thing I did. Did I gamble? Did I stay in too long? It's usually I could probably pinpoint that. And then I realize, you know what? it's not that hard. I just have to wait for my setup. And if you have confidence and you know that's coming down, then you'll keep busy. Maybe for me, it's easy because I'm doing the show and I'm always answering questions and stuff. But for other people, I don't know. It's a tough thing because trading is, you want to always be in the market, like you said. If you're not in it, you're not winning it. You don't take the shot. What the wing, Chris? You miss 100% all the shots you don't take.
The thing I want to ask you about is, so like, I don't want to call it burnout, but let's just say burnout in trading. Like, there's gonna be some times where you don't want to trade, or you feel like things are repetitive, they're always the same. I know you had this kind of period recently, and can you tell us more about kind of how you deal with it, how you go back to kind of on the other side of it?
Yeah. It was tough. I mean, I did have some burnout. Burnout comes lots of times when the market's kind of burnt out too. I think when it's exciting and stuff, you don't really realize it's burned out, but then things kind of don't work anymore. Like, it's amazing being in the market as much as I am. You see the fads that go, you see the SPAC trades, you see the meme trades. Now you see the AI trade, and how this wave goes through and it gets exciting, and the penny stocks are working and this is working. And so you always kind of rotate. And then at one time there was kind of just nothing going on. It was really, really hard in the market. And it just became a drag. You didn't know what was going on. I think that there was uncertainty with the Fed, and no one knew anything. It just felt uncomfortable because no one knew if you were going higher or lower. It was kind of a tough level I think it just it becomes a little tougher. You have to get through those times. I wish I had a magic pill to take to make myself feel better, but I think the times represented the mood in the markets. It was just everything that was going on. It was very hard to read the markets, and not reading the markets kind of give you anxiety, staying in. You didn't trust yourself. It's great when you have confidence in yourself, but when the market's not giving you the moves, maybe you start losing out. Maybe you take a bad trade or two, and you just kind of, you second guess yourself. And, that turns into a bad spiral. And I know it's easier to say, take some time off. It's probably the best thing to do is to take time off and try to get back to let the market do its thing, let the market do its thing. Hang around, watch for opportunities like something getting smashed, like a Costco, or, something with the earnings play that you have an opportunity or a big divergence that you want to get some long-term trades in. But short-term, I would just step aside and I do that. It becomes boring. It becomes boring for people, that I deal with, that I kind of trade with.
It's tough to take time off for sure. As traders, we want to be there, want to be like in the market. We want to take trades. We want things to work out, but sometimes it's the best solution to do that.
It's tough. It's tough. I don't like, and I guess we might be heading into that this in the summer. I don't know. I mean, we'll see. I mean, hopefully, that's the big thing. Do you think the market's going higher, or do you think the market's going lower? There's going to be two sides there. This story all the time. I'm more of a cup half full type of person, so I'm always kind of more of a long side trader. And being honest about that, it's just it's more difficult. I see the markets enough to know that they're rigged to go up over the long term, and I want to be part of that over the long term. I mean, we will have our pullbacks and we'll have our opportunities, but I tend to try to like to trade in a market I'm happy with. Not that I'm trying to, I'm unhappy and I'm trying to force a trade and doesn't have, I don't trade that way too much. I'll pretty much go kind of just watch the market,
People have been talking for a recession or a crash of the stock market for a long time. And you as a stock trader, do you feel like this brings some resistance? Because we've seen the market go higher and higher and sideways for a little bit, but mostly higher. And that crash is not coming. Would you feel like you should be more careful for the crash, or?
Personally, I've seen this happen, and I feel the greed in the market starting to pick up. Then I measure things out. I'm a technical guy, so I really measure out the markets a lot. Every week I go over my S&P charts. I check out where some levels are, mostly channels, recent highs, some Fibonacci's and stuff like that. But when it comes down to it, I also know psychology in the markets, and so many people hating the market is it's just a formula for the market to go higher. When so many hate it is when it goes higher. And I personally think we go higher. I don't know what's going to, now that the kind of Fed has played its cards and they're saying maybe 2 more rate hikes, maybe 3, it's going to be a long time before we see results of what's going on. That transparency is out there, and the market priced it in a lot, and then I think the market's priced that in. And then I think what's the other black swan that's going to crash this market? It's hard for me to put my finger on it. People tell me China. I don't know. I don't see that. I don't see that really happening. Russia is still kind of funky, and then the election. We have the election coming up, and that's going to be interesting. That's going to be a circus here in the United States, honestly. It's going to be a circus. I look forward to it. It's difficult to get in here up here so high in the markets, but we've seen the market's gone higher before, and I've seen the market last week rally really hard in the face of the Fed, and even everyone came on TV saying it's kind of hawkish. We don't know, and the market went up against it, and then the market continued to go up against it, and then you knew the shorts were in the market at that point, and because they just kept on getting rolled over, and it just fed on each other. I think the weekend was actually a good thing for the market to kind of get rid of that momentum, because of that, there was a couple more days. I think this market could have went higher. So now we kind of taken a breather, and it's hard to predict. I know the greed level, the fear greed index is up there. It's like 94. I haven't seen it up there in a while. I remember when it was 16 on the low side, it was fear at 16, and I was looking for the market to reverse as part of, just kind of taking in everything and taking in sentiment and what people were thinking. This market still is a kind of a tough market to read, other than historically it likes to go up higher. But I am focused, and again, I am focused on more Dow components now. And when we're talking about stocks right now, I'm not really that chasing the tech, even though I love Apple and stuff like, I think the market could hang out here. It's not going to I don't think it's going to get hit. I think the market's going to rotate out of tech into some of the bigger industrials and healthcare stocks, and they're going to kind of drive the market and to kind of hold it up here. That's my personal opinion on that.
I know we've got a lot here, and it's been already an hour in, so I want to respect your time, but where can people connect with you or find out about your work after this interview?
Well, I appreciate being on here. I mean, I love your stuff. If you're interested, come over to daytradingradio.com. I mean, I do a show every day, every morning. Welcome to come on at any time, Etienne. Actually, if you go to dtr.tv/free, they'll give you a username and password, and you could get in for free for 10 days, or you could watch it for free, but you could get all the alerts and stuff. And the education, if you head over there, just send me an email, and I can send you this business plan I have if anybody wants that. But other than that, dtr.tv/free is perfect. Just check it out.
Perfect. I'll put a link below for that for sure. People can check it out directly. And you're definitely one of the guys that I respect, who's been in the market for a while, way longer than me, and it's always cool to learn from you and to talk with you. And hopefully we can catch up pretty soon and discuss more in the future. That'll be awesome.